Hi, my name's Lucas Rogers and I'd like to welcome you along today to the Rogers Property Group. Today I'm going to be looking at cash flow. More so, I get people asking me all the time, look, I'd love to get started in property investment, but I really don't think that I can afford it. I don't think I can afford it because my lifestyle's too expensive and I don't want to change my life around and so on. So what I'm going to do today, I'm going to give you a very basic example of a cash flow for property. We're going to go through some negative gearing. I'm going to explain that to you as well. And what it's going to do, it's going to explain to you, and hopefully you'll realize how inexpensive it is to actually own an investment property. So guys, let's get started. The first thing that you've got to be thinking about is the income that you're going to be getting from a property, and you want to be maximizing that. I always say to my clients, if your strategy is to buy and hold property for the longer term, then you need to buy brand new. Okay, if you buy something second-hand, it has inherent problems with it. Lower rent, lower tax deductions, and higher maintenance. Those things you want to try and negate, okay? You want to try and maximize your rents and your tax deductions. So the example that we're going to be doing today is that's going to be on a brand new property. Okay, let's get into it. So let's assume for a moment that the property is, say you're spending $500,000 on a property. Okay, so there's your purchase price. Okay, on that property, the income coming in, let's assuming for a moment that you're going to be getting a 5% yield on that property or thereabouts. So that means you're getting $500 per week. So $500 per week, I have to use the trusty calculator, of course. 52 times 500 is going to give us $26,000 in income over the space of a year. So our rent, so that's a positive, of course, is $26,000. Okay, that's really the only income that we can have coming in from the property unless we're a little bit clever. Now, what I've been investigating lately is solar energy. Not only is solar energy fantastic for the environment, it's great for your wallet as well. But not just any solar. Don't think that you can just put solar energy on the roof and start charging your tenants or you're charging your tenants for solar energy and getting the feed-in tariffs back. It doesn't work like that. You need to have a specialized billing service to be able to gather that solar payments back from the tenant. If you want to investigate it further, talk to us. I'm not going to include it on our calculations today, but let me tell you, it'll add in about $1,500 per annum onto our cash flows. So let's go without that today. Let's just look at other expenses associated with the property. Okay, so our first major expense is going to be our interest repayments. Okay, our interest payments. Now we're going to assume our interest is at 4.5%. Okay, interest at 4.5%. So we spent $500,000 times 0.045. So that means we're spending $22,500 a year on interest. So that's going out the door. $22,500. Okay. Now, we have running costs of a property. Now, running costs of a property are things like insurance. You know, there might be some minimal maintenance, less if your property is brand new. We've got to have a property manager. We have rates, pest control and all that. Now, to run an investment property for the year is going to cost you about $6,500. Okay, so that includes your property manager, your rates, your insurance, and all that sort of stuff. Okay, so what we call it is running costs. They're at about $6,500. So you can see it's costing us about $29,000 a year to have our investment property so far, and we've only got income of $26,000 a year. So what's happening is our property is actually creating a loss, okay? It's creating a loss for us, and that loss, so our total expenses are going to be $29,000, okay, as a minus, and our income is $26,000. So what does that mean? We're making a $3,000 loss. That's making a $3,000 loss. And this is where we're starting to get into what we call negative gearing, okay? Now we're able to claim that loss against our taxable incomes to get whatever tax that we've paid, we're able to get tax back on that. Okay, but not only are we able to claim that, we're also able to claim the depreciation on the property as well. Now remember this, and very, very important point to remember. You can only claim depreciation on fixtures and fittings when it's a brand new property. If you go out and you buy a property that's secondhand, even if it's 2 months old, you're not able to claim those fixtures and fittings. Now, they make a huge impact on your property, and let me explain it to you over here. Okay, so we're probably gonna get around $4,000. I'll work it out exactly. So let's say we've got a $200,000 house, divided by 40. Okay, we're gonna get around $5,000 per year in depreciation from the structure of the house. Plumbing, walls, roof, slab, and all that sort of thing. So that's our structure. Now our fixtures and fittings, let's say that there's $30,000 worth of fixtures and fittings. If we divide that by 5, because we write our fixtures and fittings over about 5 years, that's gonna give us $6,000 a year there. Okay. Now our fixtures and fittings include things like carpets, curtains, dishwasher, aircon, and all that sort of stuff. So that means that from our depreciation alone, we've got an $11,000 tax deduction. So what we can then do is we can then add that $11,000 on to the loss that we're making. So how much of a loss are we making at the moment? Well, we're actually making on paper $11,000 plus our $3,000 actual cash loss. So we've made a loss of $14,000 there. Now our property itself is really only costing us that per year at the moment. Okay, $3,000, because that's our cash loss. So if we do 3,000 divided by 52, that means our property is really costing us $57 a week to hold. However, what we haven't, and that's what we call pre-tax. What we need to do now is include the tax deductions and the tax back that we're getting from depreciation and that loss that we've made. Assuming that I'm on a 38 cents in the dollar tax rate. So I do 14,000 times 0.38 means that I'm going to be getting back out of that $5,320. Okay, so my property is costing me $3,000, but I'm getting back $5,320 in tax. So my property is no longer costing me anything. I'm actually making $3,200 per year cash flow positive out of it. And this is how a negatively geared property can actually be cash flow positive because of the tax savings that we make. So this is why people are so misconceived in regards to how much property is actually going to cost them to hold. You'd be very, very surprised when you actually crunch the numbers and you work out property is not only not costing you anything, it's actually putting extra cash flow in your pocket. I hope this has enlightened you on how we can actually get a property to be cash flow positive. And this will only work on brand new property. It doesn't work on secondhand property. Hope you've enjoyed it, and I hope it's enlightened you a little bit. And if you have any questions, feel free to contact the office, give us a call or send me an email, and I really look forward to chatting with you soon. Thank you.